and I guess we were here.
Yes. We did low cost basis. We didn't do calendar spread.
Let's try calendar spread.
ID expects little price movement in Euro stock index over the next month from the current level of 3,500, but has a bearish long-term view. The consensus is for flat market. ATM options are available. So basically, in this one, if he has, I'm just saying, like, and this ATM options thing is confusing. But ideally, what he would do is like, he would long a put option, and he would sell so long a put option for a higher duration, and then sell a put option for a lower duration. That's what he would do.
Absolutely, absolutely. So basically, you can say that, let's say for 1 month, or maybe for 2 or 3 months, maybe he can sell a put. But for 6 months, he can be long a put because his long-term view is bearish.
Yeah.
Right? Yeah. And why he's selling a put for a short term?
That's because he believes like so first of all, by buying the long put, he spends some money, so he can offset that by selling the put. And then he also believes that there's going to be little price movement.
So my question is this: what made you think that he should sell a put? Just because he wants to offset the money, or the money that he spent, or something else?
Why does he sell a put? Because he believes volatility won't be that high.
I'm saying that this word made us think that he should sell up. Right?
Yeah.
And this word, these 3 words tell me that we should long a put.
Yes. Correct.
So it obviously tells you what could have happened in both the scenarios, but then we know. Obviously, these are very generic statements. In the exam, if you get a question, they'll exactly tell you what's going on and what would happen in this file. Let's just try this one.
Sorry, what did you say in the end?
I'm saying let's just try this one. I'm saying what they have explained over here is that they gave you that what could have happened if the price moves more than what was expected, or less than what was expected. What could be the overall outcome or the profit?
Hedging an expected increase in equity market volatility. JW has a stock portfolio and fears the market is due, so he has long stock, is due a correction, which will be accompanied by a rise in short-term volatility. He believes will go down volatility. He wants to set up a position that will benefit from higher volatility while lowering the cost of this hedge. So if he's trying to play volatility, then he's effectively trying to play for a straddle. While lowering the cost of this hedge.
What do you think in this one?
I'm just thinking. See, on the first part, just suppose we don't have consider the volatility part. He has a long stock portfolio, so essentially, if he's trying to protect himself from any fall, he'd buy a put, just so that his long stock doesn't go down. So that's the way I was thinking about it. And then now, because he also wants to play, wants to benefit from higher volatility, the best option for him is like a straddle. So that's the way I was thinking about it. But then he does pay up for the put option, which increases the cost of his hedge.
By the way, in straddle, what do we do?
In straddle, you buy a put and a call.
Buy a put and a call, right?
Yeah.
But think about this. Are you increasing the cost or are you reducing the cost?
It's an expensive strategy, so I think it increases, right?
I totally agreed, right? So what I'm saying is, that this line shows that straddle might not be beneficial because straddle is a high cost strategy. While whatever your thought process is, it's totally correct. I agree, right? Because the moment you read the line that there is a rise in the volatility,
yeah,
it will give you a feeling that straddle could be a good strategy, right? But the moment you read the line that it has to be, he wants it to be benefit from the higher volatility, but he also wants to lower the cost of this hedge, right? Which means that I don't want to be long all the time. I also want to be somehow short something.
Okay. Right.
The only way to lower my cost of the hedge is to short something if I'm long something.
So you can buy a put and then short call.
Okay, buy a put. Let's talk about that. I have a stock and fears the market is due for a correction of fall, which will be accompanied by a rise in the short-term volatility. Okay. So the price might also increase. Right? Which will be accompanied by a short-term volatility. Okay. He wants to set up a position that will benefit from the higher volatility by lowering the cost of the. Okay. If you buy a put, then when the price would reduce, then you can safeguard your position that way. You are hedging it, and then how about when there's a rise in short-term volatility accompanied by a rise in short-term volatility? It means the price again might increase then.
Yeah.
So in that case, maybe the price might increase from the current price, and then you might think that, okay, I mean, there could be regret. I'm just saying, right? Their consideration, because this is a very generic statement. I'm saying when there is a due course of correction. So let's say the price right now is 100, and it might say that, okay, it might go down to 80. But then it will be accompanied by a rise in short-term volatility. So maybe the price might increase to 105, maybe. Tell me one thing. So buying a put option is a good way, but think about this: when the question talks a lot about volatility only,
yeah,
and not about increasing the price. Look, when it comes to, so I'm giving you another thought that when it comes to increasing the volatility, one way to handle this is to buy a straddle or longer straddle or shorter straddle, depending upon if it is the volatility is increasing or decreasing. If the volatility is increasing, you can always think of a longer straddle, and if it is decreasing, you can think of a shorter straddle. But if they talk about shorting, if they talk about reducing the cost of the hedge, then I would think that, okay, if straddle is not the best way, but if it talks about volatility, how about that I invest in VIX itself?
Okay. Yeah.
Right. So I hope you know, and we talked about this before. When it comes to VIX, VIX, the volatility curve. So basically, they're not options; they are futures.
Okay.
So always think that options are obviously good options to buy or to sell. But if the question only talks about volatility, think of another thing, that investing in a VIX, basically if you're long a VIX, it will also benefit you if there's an increase in the volatility.
Got it.
Right? So this way you can go for VIX futures. And let me tell you, in VIX futures, there are no forwards in VIX.
Okay.
Right. So there are no OTC products for VIX. So the only thing that you can buy is VIX futures. So when it comes to volatility, and if it only talks about volatility, then think about VIX futures that you can buy, and that's how the volatility would increase, you will earn. Right. Now, when it comes to lowering the cost, right, then you can obviously sell something wherever you think the market would not go. Maybe a OTM call, maybe a OTM put, maybe if in the long run the volatility reduces, then you can short the VIX.
Yeah.
Right. So wherever it goes, you can change the direction. But I'm saying when it comes to volatility, something that you can think about is longer VIX. Make sense?
Makes sense. Makes sense.
Let's look at this one. AS participates.
As AS anticipates a rise in share prices from 60 to 70 over the next 3 months, with no change in implied volatility of the associated stock options. He wants to recommend the 3-month long call that will maximize profits if this happens.
So when they say there's no change in implied volatility, it clearly means that it is a standard question.
Okay.
Right, because I told you, right, in most of the options that we studied, we assume that the volatility is constant.
Right.
So assuming that there's no rule of volatility, and just says that it anticipates an increase in the share price from 60 to 70 over the next 3 months, he wants to recommend the 3-month long call that will maximize profits if it happens. Okay, so let's just take some value that, okay, if it is, let's say the call price is 3 rupees or 3 euro.
Yeah.
Then how will he maximize the profit?
So
and what the maximum profit would be?
It'll be 7 euros will be his maximum profit. If it goes from 60 to 70. And that's the best strategy because he has to put in only an initial capital of 3 euros vis-a-vis buying the actual stock, 60 euros.
Okay. 1 second, I'm just looking at a question if there's something which is important here that I'm not really getting it. Okay, I think it's a simple question, right?
Yeah.
That if the pricing is from 60 to 70 and if there is a cost, then how can he maximize the profit? Obviously, the price increase more than 70, that his profit would be more.
Yeah.
Right. But if it is less than 60, then he might end up expiring his option worthless.
Yeah.
Right. Okay. And even I think the topic says it's a proxy for the underlying. So the idea here is that he's not really long the stock, but he's buying an option and trying to get the same outcome as the stock. But the only risk is that if it doesn't move as expected, then the maximum loss that I would have is the premium that I paid for the call.
Yeah.
I think this is just the opposite of what we know.
Email host shares that the price will suffer a decline up to 10% 1 week. This would take price down from the business. He wants to protect keeping costs. Yeah, same, but just the reverse.
Now, there's one more thing before we wrap up this topic. Is before I can reproduce this table, but let's just look at this together just to save some time, and let's just try to understand if we understand this. It's a 2x2 matrix in a way.
Okay.
Let's see this. If the outlook is bearish and the volatility is decreasing, right? Now, first of all, let's leave volatility apart. If the outlook is bearish, should you write the call or should you write the put, or what about what about call and puts?
So if it's bearish, you buy a put or you can write a call.
Right? So you understand.
Yeah.
That in a bearish market, I mean, I'm not looking at this one for now. I'm just saying if the market is bearish, so we buy the put and we sell the call. Is that correct?
Yeah.
Now, point is, look at this one. When I said that I'm not looking at this one, we are actually referring to a point when it remains unchanged. We write the calls and we buy the puts. Is that correct?
Yeah, correct.
Now the point is, what if the volatility increases. Basically, the price really goes down when the market is bearish. It's good to buy puts for sure.
So when it decreases, you're saying write calls, is it? Not buy put.
Sorry, when it
decreases, the first one I didn't understand.
When the volatility decreases, when the implied volatility decreases, then it means the market will not move.
Yeah.
When the market is not going to move much, when the volatility is going to decrease, then the way you can earn is you can write the call.
Okay. And if it increases, why don't you do both, buy put and write call?
When the volatility would increase, then the risk here is that it might go other way around as well.
Okay.
Right. So the best way is that you buy the puts and be safe.
Got it.
Look at this one. When the market view is neutral, let's just talk about bullish first. Right? It's just the opposite.
Yes.
If the market is bullish, you buy the calls.
Yeah.
And the volatility increases.
Correct.
Right? When the market is bullish, it means the market will go up, but there's a decrease in the volatility. Then you try to get some money, which is writing the put.
Yeah.
And this somewhere in between. Right?
Yeah.
And when it comes to a neutral view, right? So what does that mean? When it comes to let's talk about increasing the volatility first. We know that the volatility is going to increase, but I don't have any view on the market, which means it can go left or right.
Yeah.
What's my best strategy?
Straddle. Got it.
Exactly. So when the volatility is going to increase, volatility is going to increase, and I don't have a view if it is going to go left or right, which means bearish or bullish. Let's just buy straddle, which means buying both both call and put, so that I can earn either side. Is that correct?
Yeah.
When the volatility is going to decrease, then I would want to write the straddle so that I can get some money. I know that the premium that I'm going to get, the change in the price is not going to be more than this. So I can earn some money by writing the straddle. Right?
Yeah.
And if the volatility remains unchanged, basically it is normal. So basically it's a standard way where the volatility is not too much and I don't have a view, it's a neutral view. So I can do a calendar spread where I can go short in a short term and go long in a long term, and or vice versa, depending upon where the market is moving.
Yeah.
So basically the idea is, why do they say calendar spread? It doesn't say that you go longer calendar spread or shorter calendar spread, because it just says the strategy is calendar spread, is because so that I can ensure that I am going to earn the spread wherever the market moves. Are you okay with the whole table?
Yeah.
Okay. Let's just try one more question, really, because this is like the exact question, and then we'll go ahead.
Yeah, I'm just reading it. Yeah.
Yeah, take some time.
Yes, I think for the first one it's B.
This B.
Yeah.
And why not A?
They already have the stock. So I don't see why to get that exposure you need to buy a call.
Read this carefully. Does it say buy call?
No, it says bull call.
What does bull call?
Yeah, I think I've just forgotten what a bull call is.
Bull call is as good as bull spread, but a bull call spread. So for a bull spread, what is the problem in this strategy? Why can't I have A?
Because you're capping your upside?
Absolutely. This is the reason why A or maybe C is not an option. Your option is the option that you chose is absolutely correct. But the reason is he wants to retain the upside potential.
Yeah.
And in a bull call, maybe in a bull put, somehow, look, this is unnecessary. Makes no sense, right?
Yeah. What is a bull put?
Basically, the bull spread on put.
Okay. Okay.
Right. So we talked about that when they say bull spread, it means bull call spread.
Yes.
When they say bear spread, it means bear put spread.
Yes. Yes. Yes.
But the opposite, the mirror image of that can also be possible.
Yeah.
Which is bull put
Bull
spread
put.
and bear call spread. But they are less likely, right?
Okay.
So here, since he wants to retain the upside potential, you cannot have a bull call spread because that way your upside is limited. While in a protective put, what's happening in a protective put? The best way here is because he also owns the stock. He owns the stock, right?
Yeah. He does.
And what happens in a protective put? So why do you think? So why do you think the protective put would help him?
Because his downside is protected, and he can retain as much upside.
How do we make a protective put, by the way?
You buy put, and you have a underlying long position.
You have underlying long position, and then you buy a put.
Yeah.
Right. So that way, since what does it say? The fund performance has been quite volatile, losing about 20% the last year, right? But reported gains from 5 to 35 over the previous 5 years. So since last year it has lost 20%. So I think the good way to go about this is to buy a put so that he can save his downside. Make sense?
Makes sense.
Okay. Let's just proceed to a new topic today. You sure you're feeling confident about these things now?
Yes. Yes. Just a little bit more practice that's on my end, so I'll do that.
वो तो लगेगा. Really can't do anything about it. But at least conceptually you would know कि हाँ,
Yes,
I understand why the option is such.
Absolutely.
So the current topic that we're gonna study today, very interesting, and the reason why this is a easy topic is although it's a calculation intensive topic, but the good part about that is that there's no new thing that we need to study. It's like just general transaction that we do day in day out.
Okay.
Right. The thing that I'm talking about today is swaps. Right. I hope we understand the meaning of swaps.
Yep.
Where we really, what do? Exchange. What does swap means?
Exchange.
Exchange, right? The question first comes, why? What is the need of any kind of swap? Why do I need it?
To hedge.
Right? Okay, and what's my benefit? What's my loss? Obviously, if I'm trying to get into any strategy, I should have some motivation of doing so. Then I should be seeking some benefit or some loss. Now, a lot of time swaps happen. My voice is loud and clear, right?
Yes.
A lot of times swaps happen because somebody has some position and he or she thinks that that exposure would bring loss to him. Right?
Would be?
Sorry?
Sorry, what did you say? That position would be?
Would incur some losses to him or her.
Got it. Got it.
Right? Very similarly, let's take a very simple example that I hold a stock of NBCC. and I think that market will go down. Right? Or maybe I have invested in mutual funds which has an indirect exposure to stock market, and I think the market is going to crash. So in a way, I think that in this scenario, how about that I find a person who can take these returns from me and in return can give me FD return. Right? But think about this, right? Why do I have to do all of these things? Why can't I just sell or maybe redeem everything?
Yeah.
And then invest. मतलब इतना सारा झमेला करने की जरूरत ही क्या है?
Yeah, you believe this is like short term only. That's why you do this.
Good. First, I believe it could be short term. Second, think about this. Think about a real world scenario. Okay. The moment you sell something, you will pay some commissions. You will pay taxes.
Yeah.
This is like I'm not going into too much detail, but I'm saying this is the bare minimum that you will have to pay, right? So I'm saying, let's say on 100 rupees transaction, you pay 2 rupees commission, and on profit, etc., you paid 8 rupees as taxes. So when you sold something worth rupees 100, you get 90 rupees in hand.
Yeah.
And when you invest this, you will again pay commission.
Yeah.
Let's say 2 rupees. So
Correct.
on 100 rupees redemption, you end up investing only 88 rupees. What is the point?
Yeah.
Can you see that why do I think about swaps now? I want to reduce my exposure. That is true. But I don't want to get into these many details because this will incur cost to me. So there's a way that I can still earn FD return by not doing this, then nothing like it. Right? Achha, now, what is the benefit? Obviously, if you think that the market will crash, let's look at the same example. If I think the market is going to crash and I'm still talk to someone who can give me FD returns, then I can earn FD return by not even selling my stocks at all.
Correct.
But what is the risk? Obviously, that's just my speculation that the market will crash. Let's say the market will go 20% up. I'll end up paying 20% to this person while earning only 6%.
Yes.
Makes sense? One question that a lot of candidates ask me in class when I teach this topic, and then they tell me, they ask me, Narankur, if the market is going to crash, why would somebody get into this kind of arrangement? It is straight away risky, right? And then I say, tell me something, how does markets move? In the real world,
the
real world, how does markets move? Buyer and seller, right?
Yeah.
But why are you selling? Because you think that the market, the stock price is not going to go up any further.
Yeah.
If you have 100% guarantee, 100%, that the price will go up, why will you sell at first place itself? You will never sell. But just because you think that the market has moved a lot, the stock price moved a lot, that's the reason you're selling. But I'm sure there would be somebody for sure who would think that it still has some potential to go up. Otherwise, if he knows that the price is going to go down, why will he ever buy that?
Absolutely.
Right. So when in a real world, although we think that investors' expectations are homogeneous, right? This is one of the assumptions that we look at a perfect market. Investor expectations are homogeneous. It's actually not, because a lot of investors, they think differently. If everybody is going to think the same way, you will either have all people long or all people short. And trade wouldn't happen. So that's how the swaps work. That's what my benefit is, and that's why my risks are. Are we clear on swaps? Let's just try to understand type of swaps and how do they work. The most standard kind of swap that you would see over is when you pay something fixed coupon. Although there are different kind of swaps, but the most prevalent kind of swap is fixed versus float, where one party pays fixed and one party pays float. We usually call it as a plain vanilla swap.
Got it.
So in this one party pays fixed. Now you can totally understand the motivation of why somebody wants to pay the fixed amount. Why? Because he thinks, and I can tell you, right, what could be a standard scenario in which somebody wants to pay the fixed?
He believes that the floating will be much higher, so he wants to receive floating, and he'll pay fixed.
Agreed. I will give you a real life scenario. Let's say, a lot of people do that. A lot of companies issue bonds. Right? Some people call that as FRNs, which are called as floating rate notes. Or maybe you can say floating coupon bonds. Right? So what happens is, when a company issues a bonds and it raises some money, it just links the bond to some index, let's say S&P 500. So it says that whatever the S&P 500 return would be, it will be paying the same amount to its investor. Make sense?
Okay.
Now think about this. There's a lot of liability.
There's
a lot of liability. If the S&P return is 5%, they will end up paying 5% to investors. If the S&P return is 10%, they will end up paying 10% to investors. Now, it is very difficult. Again, they have not invested in S&P 500%. They have not invested in S&P 500. Whatever money that they raised from the investors, they obviously put that money in some project or some whatever. For whatever reason they raised the money, they must have utilized that money in that project. Am I making sense here?
Yeah.
Right? And I hope you know the all basics of why somebody would raise money via bonds.
Yeah.
Okay.
To finance,
obviously, right?
Yeah.
Yeah. The financing cost, right? We talked about, we studied WACC in level 1.
Correct.
Right? And somebody, he doesn't want to share his ownership
Yes.
to the company.
Correct.
So the best way that if the company is a good company, basically he can issue a AAA rated bonds at a lower cost. Right? Now, if he has issued some bonds, and if the bonds are linked to market, then depending upon how the market moves, and if the company believes, obviously, if the company believes that the market return is going to be higher than expected, in that case, he would have a risk that he will end up paying a lot of money to the investors.
Yeah.
Now, how about that this person finds a swap dealer? He finds a swap dealer who would say that I will charge you. Obviously, he's not doing anything for free.
Yeah.
And these are OTC products. Swap is the OTC products.
Okay.
Right? So he'll say that, okay, I am okay to take money from you at, let's say, 6%, which is fixed. Right? And by the way, assume that I'm calling it as LIBOR to identify. And they'll say that I'll pay you LIBOR plus 50. That's the deal. Right?
He will pay the investor LIBOR plus 50.
Yeah.
Okay.
And this is very realistic. I'll tell you the reason why. Because when the investors are going to put their money in the company, and if S&P 500 is paying them LIBOR, they can straight away go to the market and invest in S&P 500. Why would they really invest in the company?
Yeah, correct.
Because at the end of the day, they are still getting the market return. Their investors are not getting fixed return, right?
Yeah.
They are getting what they can get from the market. So if they can get LIBOR from the market, why would they ever go to a company and invest some money? So
yeah.
The company usually pays something over and above the LIBOR.
Yeah.
Now the company has a deal with swap dealer, right? And then it says, I'll pay you 6% fixed, and in return, you pay me LIBOR. Now, obviously, you can imagine that the swap dealer would not pay the LIBOR, but let's say LIBOR minus 0.25. Obviously, he will have to keep some spread with himself, right?
Correct.
Otherwise, why would he pay LIBOR directly? So in the whole transaction, and we'll do a lot of questions on these things, but I'm just saying, let's just try to understand how much does a company pay effectively. How much does the company pay effectively? So the company is going to pay 6 to the swap dealer.
Yeah.
So I'm putting it as minus 6. It is going to pay minus L minus 0.5 to the investor.
Yeah.
And he will get plus L minus 0.25 from swap dealer.
Yeah.
So can I say that overall cost to the company
6.75, right?
It is 6, yes, that he pays to swap dealer, plus 0.5 that he pays to this, and additional 0.25 that he is not getting from them, right? From the swap dealer. Total is 6.75, but 6.75 fixed.
Yeah.
No matter where the market moves, no matter, they will always get 6.75. They always pay 6.75. Right? How much investors are going to get? Obviously, L 0.5.
Yeah.
And how much swap dealer is going to get? He's going to pay 6 He's going to get 6.
Yeah.
Pay this plus 0.25. So he's going to get 6.25 minus L.
Right.
You understand the whole transaction?
Yeah.
Now, depending upon how the market moves, there are questions that we will solve, and there are things that we will see that no matter if the price goes up to 2%. Okay, let's just in fact do this right away. Then we'll be sure. Let's just take very simple 2 scenarios where my LIBOR is 2%, and let's just say my LIBOR is 10%. Right? So we can imagine that what we can clearly see that there is no component of L over here.
Yeah.
When it comes to company, so he's going to pay 6.75.
Yeah. Fixed.
Fixed effectively. And the swap dealer, what is the profit and loss of the swap dealer?
Depends on the LIBOR rate.
Depends on the LIBOR rate, right? So how about if it is 2%?
He makes a profit, 4.25.
Perfect. So if it is 2%, then he's going to make as 6.25, something that he's going to get, right? And he will end up paying only 2%. Is that correct?
Yeah.
And in this case, is 6.25 minus 10.
Yeah. 3.7.
Obviously, there are ways where swap dealer also hedges his position.
Yeah.
Somewhere. Yeah. Right? Because he wants to earn money, but at the same time, even
Right.
in this case, he made some loss, right? So even he wants to hedge some risk. We'll talk about that later. Right? One thing there's also I want to talk about is a lot of times there is a concept called as netting.
Okay.
And what does that mean? That if I have to pay you 5 rupees and you have to pay me 2 rupees, I'll effectively pay you 3 rupees.
Yeah.
Right? Also, there's a terminology that you would see. And it is called as, one is pair swap, right? Pair swap is the party who pays fixed. Remember this.
Okay.
Right? The person who pays fixed is a pair swap, and who is a receiver swap is the one who receive fixed. So in this case, the company is a pair swap.
Yeah.
And the swap dealer is a receiver swap.
Yeah.
Right? And obviously, when I say receiver swap, it means he will receive the fixed, but he will pay the floating. Is that okay?
Yeah.
Are you good? Are we good so far?
Good so far. Yeah.
Any questions?
No.
Let's just look at this. Let's look at this one. If the existing exposure is floating rate liability, something that we just talked about, right? The company has a floating rate liability.
Yeah.
So what should a company do? He should convert from floating to fixed. Classic example of just discussed.
Yeah.
Now company will become a pair swap.
Yep.
And when will the benefit happens? When the floating rates expected to rise. Obviously, when he thinks that the LIBOR or the S&P 500 rate increase from 5% to 10%, that's how I think about converting my floating liability to fixed, and I will become a pair swap. Is that okay?
Yeah.
Now, fixed rate liability. If I have a fixed rate liability, but I believe that the interest rates are going to go down.
This is a bit wrong now, because like companies paying fixed return only, so it doesn't matter where the floating rate is.
Okay, I agree. But if the fixed rate that I'm paying is, let's say, 8%, and I believe that the market is going to crash as in it is going to go down, and the annual return from the market will only be 2%. Why will I pay 8% if I can get into a swap and I can end up paying only 2%?
Yeah, makes sense.
Right? So why not get into a swap where I will have to only pay 2% rather than I will have to pay a fixed liability of 8%?
Correct.
Right? So if I have a fixed rate liability, but I think that the interest rates are going to fall, right? In that case, I'll convert my liability from fixed to floating, and I'll become a receiver swap, which means I will now receive fixed.
Yeah.
Right? I would say always remember in terms of what I'm going to pay. That's easy to remember. Right? So when you become a receiver swap, you might just think that what am I going to receive here? Right? Although I told you that receiver swap is when you receive fixed, but I'm saying it could be confusing somewhere. So I'm saying this pair swap is clear.
Yeah, pair swap is clear. Yeah.
So when it comes to fixed rate liability, and you know that I am really going to, I think that the interest rates are going to go down, which means just think about that. I want to pay float.
Yeah.
Right. So when I was paying fixed, I was a pair swap.
Yeah.
So when I'm gonna pay float, I'll become a receiver swap.
Got it.
Make sense? Let me just write this down. When I'm converting my float to
Fixed,
I'm effectively paying fixed.
Yeah.
Right? I am a pair swap. Right? When I'm converting my float to fixed, I'm effectively paying fixed. I'm a pair swap. Right?
Yeah.
When I'm converting my fixed to float, it means I am paying float. I am a receiver. Although it is as good as that I'm receiving fixed, and hence the name receiver swap.
Got it.
So in whatever way it helps you to remember, but sometimes it just, for a receive fix, it doesn't just fits in my brain. So मैं क्या करता हूँ, I always look at this as base because this is easy to remember. तो मैं सोचता हूँ हमेशा कि अगर मुझे फिक्स पे करना है तो I'm a pair swap. This is easy for me to remember. And then उसका opposite करना है तो I'll become a receiver swap, where if I am paying fixed over here, I will be paying float over here.
Got it.
Anything that will help you to remember things.
Yeah.
Right? Either this way or that way. Okay. Now think about this. It's just the opposite. Right? You have floating rate asset. If you have floating rate asset, as in, think about this. You are going to receive float.
Yeah.
It was a floating rate liability from a company perspective.
Yeah.
Right? Think about this now. You are an investor, or maybe you are a company, but you have a floating rate asset. So basically, you are going to receive floating. You are going to receive float. And if you think that the interest rates are going to reduce, if you are to receive float, and if you think that the interest rates are going to reduce, you would want to move to receive fixed. Right? Which means move to receive fixed means It means you will pay float.
Yeah.
When you want to receive fixed means pay float.
Yeah.
Right? Pay float as in you are a receiver swap.
Yeah.
Are you getting it? Look at
Yeah.
this. You become a receiver swap. And this is the opposite. So did you see that we effectively just created the 4 cases from this first case itself. Just spend 30 seconds in your head and just confirm me that you're okay with this kind of nomenclature. Just think in your head, agar mujhe float to fix jana hai, to what will I become? Here?
Yeah.
Sure now?
Yeah. Yeah.
If you're sure on this part, let's just try question and then I'll show you that we really don't need some formula for this. And we can straight away read the question and we can start solving जो भी हमें आता है मतलब in real world हम क्या करते हैं और कैसे transactions fall करते हैं ठीक है we'll see that. I hope you have a pen and paper, right?
Yeah, pen and paper.
Okay, so there's too much information. Let's just keep writing whatever we can see and let's just try to solve this. It is important that you create a few boxes first कि कौन सा transaction कहाँ जाएगा and then we will solve this. Maybe spend 3-4 minutes.
Yeah. It's 25 years. Okay, so he has a floating rate liability that he wants to convert to fixed. Okay. So he is a payer swap in this case. At initiation, the liability that he has to pay out is 1.5% plus 0.25%, which is 1.75%. But he believes that this 1.75 will go much higher because the MRR will increase. Because he's engaged in the swap, he has to effectively pay 2% plus maybe whatever spread that the dealer wants to make. But he's fixed, whereas because the MRR rises, he would have had to pay much more than the 2.2% plus the spread for the dealer.
So do the calculation. Tell me how much amount it is going to be exactly.
How much? Oh yeah, so he will.
No, I want to know the exact dollar amount.
Okay.
I want to understand how much he is going to pay, how much he is going to receive.
Okay.
After first settlement date and second settlement date, after 180 days, because it's a semi-annual pay, right? I'll just be back in a minute, okay?
Yeah.
Got some amount?
Yeah, so he has to pay 2.25% regardless of today, tomorrow, like he's just paying a fixed return. So that's about 670K that he has to pay every settlement date, every 6 months. Divided by 2, sorry, 670 divided by 2.
How much is going to be?
Pardon?
How much is going to be? Exactly?
335.
Sorry?
335K.
335.
So the way I did it was, so I presume no spread that the dealer keeps. So look, he has his payments are basically he has to pay MRR plus 0.25. Okay. He engages in a swap where he pays 2% to the dealer and receives MRR from the dealer. Right. So what happens is effectively then he has to pay -2. has to also pay minus MRR minus 0.25, and he receives MRR.
Right.
So overall, he has to pay 2.25%.
Correct.
2.25% on notional of 30 million comes to around 670K.
Okay.
That semi-annually divided by 2 is like about 335K.
335. I just want to see the calculation. But your calculation, the things are right that he will end up paying 2% plus 0.25%, right?
Yeah.
Which is 2.25 on 30 million and on a semi-annual payment. This is what you did?
Mm-hmm.
Right? Okay. But I'm saying, although whatever you did is right, and no matter where the market moves, the company will always pay this.
Mm-hmm.
Right? It's just that you should also be able to calculate, because the question might come in that how much a swap dealer would make a profit or make a loss.
Okay.
Because when the company is a pair swap, this is what you calculated.
Yeah.
But in terms of when the markets will move, how much profit or how much loss a swap dealer would make can also be asked. So are you comfortable with that?
Yeah, let me just do that. Basically, you receive 2%, but you pay MRR. So effectively, 2 minus the MRR will be the profit or loss for the swap dealer.
How much? 2%?
2 minus MRR into 30 into 180 by 360 will be the profit or loss.
Correct.
For the swap dealer.
Correct. So you're okay with this, right?
Yeah.
Okay. And it's a fairly simple calculation. So I assume that it could be done easily.
Yeah.
It's just that again, Ray, I want to reiterate that whatever interest rate that they tell you, if it is a 2%, it is all on annual basis and need to be adjusted accordingly with semi-annual or quarterly or whatever.
Right.
Okay. Next thing is, a lot of people also use these interest rate swap to alter the portfolio duration. Right? Think about this. If you are a pair swap, right? If you are a pair swap, it means you are paying the fixed.
Yeah. So it increases duration.
It increases the duration. Is that so?
Yeah.
But think about this. When he's paying the fixed, so is he paying more duration or is he paying less duration? So if he's paying fixed and if he's paying more duration, then effectively his duration would reduce.
I see.
Right? So fixed coupon always have more duration. You must have studied this in CFA level 2.
Yeah.
That at coupon rate, it resets to 0, the duration for a floating rate notes. Right? So
For
I'm
floating
saying,
rate. Yeah.
for floating rate, right? So I'm saying that think about this. When you are a fixed paying, when you're a fixed pair, when you're a pair swap, so you currently have more duration. But can I say that you are paying more duration and you are receiving less duration?
Yeah.
Can I say that?
Yeah.
Sure.
Yeah.
So can I say that for a pair swap, the effective duration is negative? Is that okay to say that?
Yeah.
Sure.
I think there's some echo coming.
Sorry?
I think there's some echo coming.
Is there some echo?
Let me just speak. Now it's better. Yeah, it's not there.
So I'm saying when you are a fixed pair, I'm just using the word, instead of using the word fixed amount, I just replaced it with the word duration. So I'm paying more duration and I'm receiving less duration. So when I am a pair swap, I am giving more and I'm getting less. Hence, my duration is negative. Are we okay?
Yeah.
You are sure about this? Also, when it comes to modifying the duration, it's a fairly simple formula. And the questions are very easy. So basically they say that, let's say you want to do the swapping and you want to alter the modified duration, etc. So it is like this: how much is the modified, how much is the target duration, minus how much is the current duration of the portfolio, divided by how much is the duration of the swap.
I see. That will give you what? That will give you what?
It will actually give you the notional swap principal.
Understood.
And obviously you will have to, this is the duration, but since this is the amount, so you will have to multiply with the amount, right? Which is the market value of the portfolio. So I can say that if my current portfolio has a duration of 2 and I'm thinking of increasing my duration of 4, but the swap has a modified duration of 1.5, and I want to do this on a notional principal of 30 million. Right? So depending upon if it is positive or negative, we can say how much notional principal does he have to swap. How much notional principal does he have to swap to change the overall modified duration? Basically, the idea is that I'm trying to enter into a swap, but I don't know of how much notional principal. But my objective is to change my overall portfolio duration from 2 to 4. If my overall objective is to change my overall portfolio duration from 2 to 4, and I have my notional principal 30 over here, current value, then how much notional principal should I exchange or swap so that my portfolio duration becomes 4 is this much. Is that okay?
Yeah.
Let's just see if we understand this part.
So the question.
Sorry? Yeah, this question.
Yeah. Okay. So target duration is 6. Current is 4.5. So 6 minus 4.5. A pair swap has a modified duration of -2 and receiver swap has a duration of 2. Okay, what type of swap will achieve the desired portfolio duration and what is the required notional principal? So since she wants to increase duration, she will have to So you have to buy a receiver swap. So 6 minus 4.5, which is 1.5 divided by 2 into 120 million. That'll be the notional. So 60, yeah, about 90 million. About 90 million?
90 million, absolutely. And he would be receiver swap or a pair swap?
A receiver swap.
Okay, perfect. And you can clearly see that he mentioned that a pair swap has a value of -2
Negative. Right.
swap has a +2. Okay?
Yeah.
So now you know what's going on and what needs to be done
Yeah.
in this. So your answer is right and even the logic is right. Okay, perfect. Now let's go to another topic. FRA. What is an FRA? Have you studied this in CFA Level 1?
Yeah. Yeah. I don't remember it, but I remember the forward rate agreement. Okay.
So if you remember this, we had some kind of a nomenclature F1, 3.
Oh yeah. Correct.
3 months forward rate 1 year from now.
Correct.
So I will say that we fix something today, and after 1 month, I'll enter into a 3 months contract.
Yes.
We enter into an FRA.
Mm-hmm.
So some people write as F1 cross 3 or something.
Mm-hmm.
But the idea is still the same. Idea is still the same, where you think that interest rates are going to move up or down, but you want to fix it right now. Think about this. What could be a standard situation where you would think about getting into an FRA? We understand why do we enter into swap, right?
Yeah.
How about FRA? The idea is still the same. The idea is still the same, that we are trying to fix something, right? We're trying to fix something, but what is it? Think about this. If I think that the interest rate can go up or can go down, let's say, and I'm not really adding a component of FX right now, but just telling you of a situation that think about that I've done some business. I've done some business in US, and they agreed to pay me $100,000
Okay.
at the end of the month.
Mm-hmm.
Right. So basically, today is 1st Jan, and I'll receive this on. I'm telling you very crudely, in a very crude manner, but that's just giving you an idea of why do I need to get into an FRA. Today is 1st Jan, and I know that on 31st of Jan, I will be receiving $100,000. Now, based on the FX rate, I might get $105,000, or let's keep it simple, 100 only. I might get 105 or I get 95, right? Depending upon FX rate. Now, if I can get 105, nothing like it, good for me. But what if I get 95? I don't want a risk. So how about that I enter into an FRA where I can fix a rate? What I can do is I'm going to receive this, so I can basically short a contract.
Yeah.
Where I would say that I would be selling $100 after 1 month, from 1st Jan to 31st Jan, and I would be long INR.
Yeah.
specified rate. So I logged in today itself, irrespective of what the market and how the market would move after 1 month. I just logged in the price so that I am sure now that this is the amount that I'm going to get after 1 month.
Got it.
Is that okay?
Yeah.
There's another way of looking at it is, I told you in terms of FX rate, but then it plays a bigger role because the exchange rate could move. Or maybe I could give you another example that little bit in line with what we just discussed. Let's say I just started my own company. And this company is a manufacturing company, right? And I will have to buy some machines, right? The paperwork is still going on. And we obviously look at the cost overall, the cost of borrowing.
Yeah.
And then which overall comes to the overall cost of production.
Mm-hmm.
And then from cost of production, I will also look at my revenue. And then I look at my profits.
Mm-hmm.
So there's a lot of things are being dependent upon my cost of borrowing, because this also takes a lot of chunk of my overall money. Right? The cost of borrowing, and I think that for these machines, etc., I would want to raise $100, or I want to borrow $100 from the market. The current market rate is 2%. And if I plug in this 2% in my overall cost, right, it just works for me, which means the calculation seems right, my profit margin seems right, and I'm okay to borrow at 2%. But since paperwork is going on, I don't want to borrow right now. Right? I will be buying for 6 months, but actually 1 month from now. But I don't know what the market rates would be.
Yeah.
Right? If it is 1%, or it could be 5%, who knows? So what I'm going to do is I actually want to lock in my interest rates today itself at 2%. Right? Think about this. After 1 month, do you think that that I will still have to pay, or the market will not move or move? The point is, after 1 month, the market will move however it wants to move.
Yeah.
But at least by entering into an FRA, I effectively locked in my price at 2%, so that I will end up paying only 2% for the whole duration, which I initially discussed. And obviously, nothing comes free. So to enter into an FRA, I have to pay some upfront cost. And isn't it as good as the premium that you pay for insurance?
Yes.
The premium that you pay, but then that's something that you need to pay, right? Because otherwise you will not be able to lock in the price.
Yeah.
And think about this, a lot of times, even for insurance, when you pay, nothing happens to your vehicle, and then the insurance will go worthless.
Yeah.
But that's the cost of security that you're paying.
Yeah.
So the point I'm trying to make is, the idea of FRA is, although you will be effectively paying a lot, but at least at the expense of guaranteeing the interest rate that you're going to pay. All right, let's just try to understand the same thing from a question, and let's see if it makes sense. Can you see this? Long 2-6 FRA.
Yeah.
What does that mean?
2 months from now, you'll enter a contract that effectively. Yeah.
But let me tell you this, when it says 2/6, what does that mean? You are
Oh, it's from
entering
today.
into,
It's from today.
sorry,
Got it.
yeah, absolutely. So when it says 2/6, it means
Mm-hmm.
that you will be entering into this from 2 months, which is T60. But when you
Mm-hmm.
say 6 is the overall duration. So you will be entering into the contract after 2 months for another 4 months. Can you see that? So in
Yeah.
nomenclature, when you look at 2 cross 6, it means you want to get into after 2 months for another 4 months. Effectively, it's
Yeah.
called as 2 cross 6. Okay. Now let's just look at this. And let's just try to solve this end to end.
One second. Yeah. So wait, you can do an FRA with floating rate as well?
Yeah. So basically, FRA has nothing to do with fixed versus floating.
Locking in the price.
Yeah, it is more about locking the price. Yes.
Yeah, it's a bit confusing over here for me. Confusing as in like.
So let's go one by one. Let's go one by one. I'll give you some hints. So the point is, it says calculate the firm. Let's just read this again.
Yeah.
Smithy's PLC needs to borrow 1, 2, 3, 4, 5, 6, 1 euro. I think it's GB, right? Okay, anyways.
Yeah.
So let's just 1 million euros for 180 days.
Yeah.
90 days from now at the market reference rate plus 50 bps. Okay.
Yep.
So it says for 90 days from now. So since they are not using anything in terms of cross, basically F90 cross 1, whatever. So we are easy in understanding of how the timeline would move. So it says t equal to 0. And it says needs to borrow this money for 180 days from now. So this is 90, this is 270. Because he wants to borrow for 180.
180 days. Yeah. Very clear.
And at the market references plus 50 bips. So whatever the market rate would be plus 50.
Yeah.
The company is concerned that the interest rates will rise over the 90-day period. Basically, they say that it might increase somewhere over here. And then increasing the cost of 180 days loan, obviously, something that we talked about. Right? He might just say that it might increase somewhere in between. So this for this 180 days, the cost of borrowing would be too high.
Yeah.
Smithies take a long position in an FRA on the 6 months reference rate, 90 days in the future. So basically, they say that they fixed in a price. It is very important to understand the timeline that it's the same. What they're trying to say is they are taking a long position on a 6 months reference rate, 90 days in the future with a forward rate of 5%. So basically, it is in line with what we are solving. So
Correct.
I'm saying, although this is little unlikely, but then how about they gave you a 6 months rate but 30 days from now? Here they say that they are giving you a 6 months reference rate but 90 days in the future, which is what we need.
Yeah.
Right? So we are getting into an FRA. By the way, we enter into an FRA here itself, obviously, because we are locking in today. But the FRA rate is for the 6 months, same. 90 days from now, same. But I'm saying, do not assume it. The question explicitly says that the FRA is on 6 months reference rates, 90 days in the future. So it clearly tells you that it is for the 6 months reference rate, 90 days in the future. It means we are in line, something that we want. How about if the question changes that it is for a 6 months reference rate, 30 days in the future? which
So
means
that doesn't work out for us.
Yeah, but then it will give you more information then. It will give you more information to reach to this point, which means that they say that the spread is then this and the interest rate for another 60 days, because then they'll tell you 30 days over here. To move to 90 days, there's another 60 days.
Yeah.
Then they'll tell you 60 days forward, it could be this much.
Oh, okay.
Right. So I'm saying it is important to understand that the timelines are in line. If they're not, then it is important that you bring them in line.
Yeah.
All right. So they say the FRA rate is 5% and the notional is, again, the notional is same. You will get notional same obviously every single time. Otherwise, if the notional is not same, then it will be really difficult for you to calculate anything. Right?
Yeah.
So I'm saying that the notional value will be same in the exam. I want to borrow this and the FRA rate on the same notional is this much. Are you getting what I'm saying?
Yeah.
You want to borrow 1 million GBP and the FRA rate that is available in the market is also on 1 million GBP. So I'm saying these two values will be same in the exam.
Yeah.
And it will be same in the exam.
Yeah.
Because if they say that if it is 5% on 500 or 0.5 million GBP, then it's a lot of mismatch. They will not test you on those things.
Yeah.
Okay. All right. So they say that the FRA rate is 5%.
Yeah.
So basically, by entering into an FRA, you can get into an FRA that you will end up paying 5%, right? Basically, what they say is, what do you think that he will receive effectively?
He will receive the difference. The difference of the rate that's actually there and how much he's paying. So like 5%, suppose it's 7%. He will receive 2%. Is that how it is?
No. Let's look at this one.
Yeah.
Let's take it a little simpler way. Let's say there is no FRA.
Okay.
How much his cost of loan would be? Let's say there is no FRA, and then it says, the question says that calculate the firm's borrowing cost on a loan net of FRA fixed payment for realized 6 months. Reference values 9 days from now is 7% and 3%. So let's look at 7% first. Had there been no FRA agreement, how much his cost of borrowing would be?
7%.
Can I say it is L plus 0.5? Question again. He needs to borrow 1 million GP for 180 days, 90 days from now at a reference market rate plus 50 bips. So forget what he's thinking about FRA. Forget FRA.
Yeah.
What is his cost?
L
plus at a 7%. So it's going to be 7.5.
Oh yeah. Got it.
Right? Reference rate, which is 7%.
Yeah.
And think about this, there is no FRA at all. Had there been no FRA, he would end up paying 7.5, 7 plus 0.5.
Yeah.
For how much? 180 days.
Yeah.
So multiply 180 by 360.
Yes.
On a notional of 1 million.
Yep. Yeah.
This translates to 7.5 by 100 multiply 1 by 2 basically.
Yeah.
Whatever. It is going to be around 37,500.
Yeah.
Is that okay? Right? Now, since he got into an FRA with a forward rate of 5%.
Yeah.
Which means he fixed in at a price that he will receive 5%. Right? So when he's going to receive 5%, how much he's going to receive? But he'll pay 7%. The FRA is a net thing, right? So
Yeah.
the net thing is that irrespective of the market, so basically he'll pay 7 and he'll receive 5.
Yeah.
When I'm long FRA, when he is long FRA, right? So he will receive 5. Actually, he sorry, one second. When he's long FRA, he'll pay 5 and receive 7. No, just give me a moment. I'm just thinking of how do we look at this. On a 5% fixed FRA, if the market rate is 7% effectively, then he will receive 2%. And why does he receive 2%? Because one second.
Yeah.
We just got confused with this. Okay, yeah. Let's look at this. The long position in an FRA will receive the payment at settlement if the market rate interest rate is higher than the forward rate FRA. Right? So basically, when I logged in at a price of 5%, and if the interest rate is more than 5%, I'll receive the payment.
Yeah.
Right? So if the market interest rate is 5%, the 7%, and we logged in at 5%, right? So I'll receive 2%. So what I'm saying is, so the FRA is like a deal. So what we say is, so it's a deal when they say that let's lock in at a price of 5%. If I am long FRA, right? And think about this in real terms. If I'm long FRA, or maybe let's just call it you are a long FRA. You get into a contract with me, right? But what is your expectation? Your expectation is when the interest rates goes up, you want to pay less. Is that correct?
In the interest rate, yeah, correct.
That's the reason you are getting into an FRA. Otherwise, there's no need of getting into an FRA.
Yeah.
You are a long FRA. You, as in Gaurav, is a long FRA because he thinks that if the interest rate goes up, you don't want to pay more. Right? So when I say that for a long FRA, if the reference rate is 5%, if the market rate is 7%, then you will receive 2%.
Yeah. Correct.
Otherwise, if you have to pay 2%, you don't have to get into an FRA itself, right?
Yeah.
Just because you think that the interest rates are going to increase, you are a long FRA. Make sense?
Clear. Yeah.
Just because you think that the interest rates are going to go up, you are long FRA, which means you think that you will end up paying lesser while the market interest rates would be more.
Yeah.
Right? So in this case, when the interest rates went up to 7% and FI rate was 5%, you will receive 2%. The difference, which is 7 minus 5, right? Obviously on the same duration, which is 180 by 360, multiply 1 million.
Yeah.
Which means you will receive 10,000.
Yeah.
Right. So what I'm trying to say is when the actual day would happen, you will still have to pay in the market 7.5.
Yeah, but you will receive it. So effectively,
But since you will receive something, your effective rate of interest would be lower.
Yeah.
So effectively, you will pay initially 37500. What you will receive is 10,000. Effectively, you will pay 27500.
Yeah.
Does it make sense?
Makes sense.
But the problem with FRA is that it's not an option. What does that mean? It means when the interest rates goes down to 3%, when it goes down to 3%, in that case, you will actually, the cost of borrowing from the market is 3 plus 0.5.
Yeah.
Right? Multiply again 180 by 360. Multiply again
Yep.
1 million. This is something that you will pay.
Yeah.
And what you had to receive is again 3 minus 5. Multiply 180 by 360. Multiply 1 million.
Yeah.
So effectively, you will pay in this amount, and you will also pay in this because it's going to be negative.
Yeah. Clear.
But the idea is that even from this value is going to be 17500 for real. I'm telling you with the numbers.
Yeah.
And from this, it is again going to be 10,000. Which means you will again pay 27500. Can you see? What does that mean? It means irrespective of the market moves, yeah, you logged in your price at some rate.
Yeah.
Is that clear?
Clear.
So your cost of borrowing would effectively be 27,500, which you will pay at the end. This is the difference, basically.
Yeah. Clear.
I was thinking of telling you one more point over here is, have I covered everything? I think I have covered everything pretty much. Yeah, so the idea over here is that we log in at a price, right? Okay, one more thing. So there could be some questions. There could be some question where they say that this transaction would happen over here.
Yeah.
Right? So they might ask you that what is the current value. You can read the question, and the question might ask you what is the current value, but then they will also give you a discount rate.
Yeah.
So it will become a simple TVM question where you have to bring it back to this value.
Got it.
Right. So I'm saying one of the option in the exam would be 26,500, 27,500, and one of the option would be, let's say, 25,580, which will be the discounted value of this.
Yeah.
Okay. So I'm saying always read the question and always create a timeline and see where do they want us to answer and at which point in time.
Clear.
All right. There's one more question, or there's one more topic called as STIR.
Okay.
It's called as short term interest rates. Okay. Now the point is that a lot of time FRA is a OTC product.
FRA is the
OTC product.
Yeah.
Very similar to forwards, right? But a lot of time they are illiquid, right? And you don't have enough market. In such case, you can refer to futures, which is STIR futures. Okay. Now, but what is the problem in this? The problem with, by the way, do you know the basic issue of a futures versus forwards?
Yeah, the default risk.
Okay, true. You have a default risk in forward versus not in futures. But another problem of futures, which is a kind of advantage in forwards.
Margin, how much you have to put up.
Okay, true. True. These are all nitty-gritties, but one thing that I want to mention over here is, since futures are standardized, right? So they are only be available for a few days. Basically, let's say 30 days, 60 days, 90 days, right? But since forwards are OTC products,
Yeah.
they can be available for, let's say, 45 days or whatever, right? You can always customize them. Right? So I'm saying that when it comes to futures, you might, let's say you want to lock in at a price for, let's say, 45 days or some other day, right? So I'm saying it is not possible to get a standard contract or standard future every single time, right? So in such cases, you can use STIR, and there's a simple calculation of a basis point,
Okay.
that we need to remember for this. This is a little specific to this, and you will see something called as BP, right? Something that you need to always remember, and it comes to SIS specifically, is two things, right? I can in fact show you, that will be easier for you to remember. Yeah. So they say, look at it, something that we already discussed, that they are standardized product which are available or usually quarterly, right? But then a lot of people would want to hedge somewhere in between, or maybe something that doesn't work for futures. To fix that, they use the word euro dollar futures, and then they say they are priced at a convention 100 minus annualized forward rate. So the euro dollar futures, they're priced at 100 minus annualized forward rate. So if the forward rate is 2%, so their value is 98. Right? Also, and I'm going to tell you how do we use this in the question. Also, they say that a 1 basis point change in the forward rate will cause the contract value to change by $25. You can use this information as it is, or you have the calculation already. Why do they use this? Is 1 bips, right? 1 to the power 10,000, and this is since for quarterly basis. So this is 90 by 360. So they say for on a 1 million contract, for a 1 basis point change the forward contract will result in change the contract value by $25.
Yeah.
Does this part make sense?
Yeah.
Sure about this?
Yeah, I'm just reading it. 1 second. Yeah, this I understood. Yeah.
Sure.
Yeah, this I understood. Yeah.
Now let's just see. And again, when we look at the question, we'll again go back and try to understand what are we long with, what are we short with, how much do I have to pay, and how much can I get. Is that okay? But the only thing is, when we look at a future rate, we would know how much the price would be and how much the change I can get in my overall portfolio if I'm going to longer contract or shorter contract. But then we'll try to understand more this with a question. Read this question, make some timelines, maybe spend 3-4 minutes and see what you can do about it. And then we'll solve this together.
Yeah, it's a bit confusing for me. It's like,
all right, let's just solve this together. So it says Alan Gard is expecting to receive 20 million inheritance in 120 days. Okay. Alan intends to invest the 20 million in a 90-day deposit account at a market reference rate of LIBOR or reference rate minus 25 bips. So basically, he intends to invest. So basically, assume that he received 20 million, right? So he will then go ahead and invest this in a bank.
yeah.
At the rate L minus 0.25 for 90 days. So far, so good? Okay. And then it says, currently, the euro dollar futures expiring in 120 days are trading at 95. Okay. So he is actually now thinking about the whole timeline where this is 120. Right. And then it says, currently euro dollar futures expiring in 120 days.
Yeah.
Are trading at 95. Okay. So they are currently trading at 95. Alan is concerned that a short-term rates may fall before he makes his deposit and would like to lock in at a guaranteed interest rate today. So what he's saying is, since he wanted to invest at L minus 0.25, he's thinking if L will reduce, he will end up investing his money at a lower LIBOR rate, and hence he wants to lock in the price today. Is the question clear?
Yeah.
And he makes his deposit and would like to lock in at a guaranteed interest rate today. He takes a long position, 20 euro dollar future contract. So basically, he bought 20 contracts for this date so that he can lock in the price.
Yeah.
Before we go to A, can you read this again and confirm whether you are okay with the asking that what's going on?
Yeah.
Sure about that?
Yeah.
So it says after 120 days, the 3-month reference rate is quoted at 3.5. Alan closes out his future position and invests in 90 days at a market data. Okay, okay. So what he's saying is the reference rate is going to be 3.5 at this point, and how much he earned overall. Okay. Let's just break this question in 2 parts. One thing is, first, had there been no future contracts, by ultimately the future contracts is going to increase or decrease his overall income somehow, right? Depending upon how they move. But is it right to say that he will end up investing in whatever the prevailing rate would be at that time?
Yes. Yes.
Similar to how we did the previous question?
Yes.
We said, let's say there is no FRA, what is the cost of borrowing? And then we did a subtraction or minus based on the FRA.
Based on the FRA, right?
Right. So let's say that at the end of the day, he will end up investing in the market itself, market as in the market rate itself. Right. So we will see what this is going to bring positive or negative effect. We will see that. But can I say that the amount that he's going to receive from investing is going to be L minus 0.25? Look at this. You want to invest for a 90-day deposit. You want to invest 20 million for 90-day deposit at a reference rate of L minus 0.25. So can I say that he is going to earn 3.5 minus 0.25 multiply 90 by 360 multiply 20 million?
Yeah.
Is it right to say?
Right.
अभी मैंने कुछ भी नहीं सोचा. I haven't even worked on the contracts, etc. Right? So this is going to be 3 point. How much is going to be? Can you calculate this for our reference? So that we would know.
3.25. 3.25 divided by 4, which is
60 multiplied 20 million. So he will receive how much?
Yes, calculating. It's about 0.895 into 20 million.
How much is going to be the value?
Yeah, let's say. I'm just taking a calculator. 160K?
So this is going to be exactly 162,500.
Yeah.
Okay. So this is what he's going to receive from the deposit.
Yeah.
Okay. Now this overall deposit or the amount that is going to receive at the end might increase or decrease depending upon how the futures has performed. Because what we have calculated so far is without anything. Right? Okay. Now let's see. The question says that currently the euro dollar futures are trading at 95.
Yeah.
Right? So basically, he takes a long position in 20 contracts.
Yeah.
Right? So can I say that he basically is long 20 multiply?
He's long 20 multiplied by?
Can I say that he is effectively 20 multiply 95 kind of?
Yeah.
20 contracts at rate 95?
Yes.
But the idea is, I want to know what is the value would be. What would be the value after how many days? After 120 days? Because that's how it's going to expire, right? So if I'm long 20 contracts futures, I want to know how my future value would look like after 120 days. So it says that the 3 months reference rate is quoted as 3.5. And we know from the text that the prices of the future can be quoted as 100 minus the rate.
Okay.
Can I say this is going to be 100 minus 3.5? It is 96.5.
Yeah.
So can I say that he invested at 95? And it became 96.5. So basically he earned 150 bips. Is it right to say?
Yeah.
150 bips per contract, and per bips value would be $25 in terms of number of change in the portfolio value.
Yeah. It's 25. How did you get? How did you get 25?
So remember this. So for a 1 bips change on a 90 days, on a 1 million, it is 1 million multiply 90 by 360 multiply 0.0001.
Yeah.
Look at this calculation.
Yeah.
Right. So it's a 1 bips change in the forward rate.
Yeah.
So it says 150 bips. So total it is going to be 150 multiplied 25. This is on a 1 contract. How many contracts did he buy? 20 contracts.
20 contracts. Nice.
Right. So this is I'm already taken care of the profit. This is only the profit, right?
Yeah.
The difference of 96.5 minus 95.
Correct.
And I'm not using 1.5 or less than that or in terms of cents, because I've already taken care of in terms of bips.
Yes.
Right. I've already taken care of bips in terms of, look at this one, 0001.
Yeah.
So I'm saying 150 bips multiplied $25 is a change, multiply the 20 contracts that I bought. And this is again a positive because I received it. The future market value is more than what I paid initially.
Yeah.
Right. So the overall profit is this much.
Very clear. Yeah.
Does it make sense?
Yep.
The total return is going to be this is 162,500 plus this is going to be 75,000. So overall we know 2,375.
Yeah.
The point is that we look at something as standalone and then we do a plus minus depending upon what are we trying to achieve.
Yeah. Okay. Yeah.
So what I'm going to do is we'll start off with the same thing again on maybe Thursday.
Yeah. Perfect.
Right? And then we'll solve one more question on the same concept, and then we'll take it from there.
Okay. All right. Thank you.
Right. So I'll see you on Thursday same time, and
Yeah.
continue.
Perfect. Thanks.
Thanks, Gaurav.